Consistent investment growth across all market conditions is the key to building long-term wealth. But this isn't always easy to achieve. Markets can be unpredictable, and human biases can often lead to irrational investment decisions. Behavioral finance shows how these biases can impact your investment outcomes. If you've ever held onto a losing investment too long, hoping for a recovery, that's one psychological trap at work. Loss aversion. We're hardwired to try and avoid losses, because that pain of losing feels more intense than the feeling of a gain. That's why you might sell a stock too soon after it rises, locking in a small profit to avoid potential future loss. And then there's the lottery effect. We know the chances of winning the Powerball are around 1 in 134 million, yet we're willing to accept a high probability of a loss for a small chance of outsized wins. Even when you understand these biases, it's still hard to avoid them. But there is one investing style that not only avoids behavioral biases, it can turn them into opportunities. It's called systematic investing. Systematic or quantitative investing combines data science with human intelligence. Think of it as a strategy that sits between passive index investing and fundamental analysis. It builds and extends the depth of data from a fundamental approach, but applies it at scale across the entire investable universe. The result? An actively managed portfolio of stocks that begins with the index investment but is actually making small adjustments onto stocks above or below their index weights to potentially achieve better returns than a passive fund. So, here's how systematic investing works. It starts by gathering vast amounts of data, the same data fundamental style managers use, plus a whole lot more. The difference is in the scale. For example, Macquarie's systematic team processes over 100 million data points every week. That's around 700 to 1,000 per stock, spanning nearly 27,000 stocks globally. In fast-moving markets, no single analyst or investor could deeply understand thousands of stocks at once. But a systematic model can. The model identifies potential opportunities by analysing signals from the data. Some signals highlight a human bias opportunity. Others might focus on risk management, while some could target factors like growth, value, or quality. Over more than 3 decades, the Macquarie Systematic Investments team has built a library of over 1,000 signals, fine-tuned to capture different market opportunities. Its model calibrates and weights around 65 to 70 different signals to optimize a portfolio, ranking stocks by their potential to outperform the index. The power of systematic investing lies in its ability to blend these signals. For example, value signals might perform well in one market, quality in another. But when we combine 60 or more signals in the right blend, we can aim to target consistent excess returns. Even if you beat the benchmark by a little bit, when that gain is compounded, it can accelerate your wealth goals. Until recently, systematic models were mostly only available for large institutional investors, like your super fund. But with systematic active ETFs now listed on stock exchanges, it's easy to access this investment style. Cut through market complexity, turn behavioral bias into potential opportunities, and do more than follow an index. Get started with Macquarie's systematic investment solutions today.